What is going on, Hot Take Nation? It is David Ramsdenwood here for another episode of the Hot Take of the Day podcast, and this is episode 100. We started this back around a year ago, and the world was relatively normal. We had just assassinated an Iranian general. Oil was 63. The last 365 days did not go as planned, but if you were fortunate enough to have gone into a coma approximately 365 days ago and came back today, you actually would be fine. Oil's back to 53. Energy equities are only down 10 or 20%. The stock market's up kind of 10, 15% from that point. Things feel normal, but if you weren't in a coma for the last 365 days, you have seen things that you never thought that you would see, and theses have changed and gone up and down. And so for our 100th episode, I am very fortunate to be being joined by Art Berman, who I really have a lot of respect for, and I get a lot of insight into commodity prices and what's going on in the energy industry. We had him on the show last summer. He is back. Art, welcome to the show. Were you one of the people who got to be in a coma for the last 365 days or no?
I've been in a coma for the last 40 or 50 years, David. That's so nothing changed for me. Nothing
Oh, perfect. Well, you and I are going to have to talk about how that happens.
Right.
Okay. So let's start with the macro and let's talk about oil prices, because it's been crazy, and you and I are both on Twitter, although post the January 6th banning by Twitter, I am now not really on Twitter as a protest. But in the summer, you will recall that it was everyone's going bankrupt. These shale cos are horrible. There's so much inventory. Everyone's getting crushed. Stocks are trading down 90%. And the bearishness was unbelievable. And then the vaccine comes out. There's views of demand. And, I think I'd seen a piece from you, I want to say September, that was sort of like, the world's changed, and if you're expecting a commodity super cycle, you're crazy. And maybe I remember that incorrectly. But it seems like the bulls are just out. What is your take on what's changed, and where are you seeing the commodity price environment right now for oil, and then we'll talk gas?
Sure. Well, what I may have said back in September was that I did not see. I think I was reacting to Gehring and Rosenzweig's thesis that it's kind of an ongoing thesis they've had for a while, that we're on the cusp of some great commodity super cycle. And I didn't agree with them at that time, and I don't agree with them or anyone else who believes that right now. What I think we're seeing, certainly in energy, is okay. We're coming out of the big sleep, and people can imagine a world in which demand is more or less normal, and therefore what does supply look like? And so for me, it's always about supply. I don't understand the obsession in oil markets with demand, but be that as it may, from my perspective, it's always about supply. Markets have zero ability to do anything about demand. Markets can control supply by sending different price signals, and that's exactly what they do. And so if anybody wants to have a more in-depth discussion of price formation, we can do that at another time. But price formation has nothing to do with demand. Supply and demand, as long as they're moving in tandem, demand can go 50 million barrels a day, and as long as it's balanced by the right supply, markets are happy. Markets don't care about absolute values. So that said, we are feeling or about to feel the results of shutting in wells, not drilling enough wells, not spending enough capital. And we have not yet begun to see substantial tightening of supply, although there are analysts that any day of the week in any given month or year will tell you, oh, the physical markets are tight. Well, okay, you can listen to them. They're pitching their book, I think. But the reality is that we are going to see substantially lower supply, particularly from the United States, in the coming months. And there's not a thing in the world that can be done about it. And so we're just going to have to live with it. And the bullishness in oil is because the market is sending a price signal saying you guys need to get busy and drill. Nobody's worried about supply next month or in the next 2 months or 3 months. Markets are looking out to, well, what's going to happen by summer or fall, and we will be short by then. It's certainly in the United States.
So Art, I love that you're talking supply because the demand, I was doing some work this weekend to just try and figure out demand, and the only and this isn't even insight, this is like the Captain Obvious statement of all time. But I think the drop, because we only use 6 million barrels a day for airline travel, and the US went from 13 million barrels a day to roughly 11, and air travel's down 33 to 50%. So roughly the decline that we've seen in the US basically offsets the travel. And so when I'm thinking about a bull thesis, assuming travel comes back to normal, I can certainly see the supply shortage. What I'm curious about though is, for 45 days, the world overproduced roughly 25 to 30 million barrels a day when the world wasn't balanced, as you talked about. So that would be the mid-March to beginning of May when OPEC cut. So that put 1 billion barrels in the market somewhere. We're doing about 94 million barrels a day of demand right now, and OPEC is down 8-ish. So we were at 100, the US has lost 2, OPEC's down 8. We're producing somewhere between 90 and 92, depending on Libya. It feels like we're really well supplied. And so at 2 million barrel a day delta supply demand, that would take 500 days to burn off the 1 billion barrels in inventory. And OPEC could, if prices go up, just open the taps. So where I missed clearly, because I was calling for $35 oil at year end, and that it would take until 2022 to see a recovery. But people have really looked past that. What is your take on the excess and OPEC and stuff, because on the world is undersupplied concept? And then we'll talk about US drilling and how for sure the US is declining.
Sure. So there are so many moving parts in any complex system, and oil is one of the more, if not the most complex system, and our entire civilization and economy is founded on oil. So that's another conversation altogether. But so the simple way to look at it is to ignore all the numbers, to ignore is 94 million or is 96 million or is jet fuel 6% or is it 5.8% or whatever. And so what I look at, and I think what markets look at, is inventory. And because the numbers are uncertain, they go up and down, but the ultimate source of supply, it's like saying, look, I don't really know how much money's in my checking account today, but I know I've got $10,000 in savings. And so whatever happens within reason, I can be way off on checking, but I know I've got enough in savings. Or conversely, I got nothing but whatever's in checking. And so if I can't pay for it out of checking, I'm in trouble. So storage or inventory is the savings account. And if we look then at the storage that we know about, there's a lot we guess about, but we know fairly closely what's going on with U.S. storage. And U.S. storage is moving very quickly towards the 5-year average, where we've gone from 150 or 175 million, depending on which refined products you include with crude oil, and we're down to something like 25 or so, and we're losing about 5 million a week. So we're almost at the 5-year average. If you look at OECD, we're at the 5-year average. So we're right at that inflection point between when markets are long and markets are short. If you have a surplus of inventory or comparative inventory, markets are long, or short rather. If you get into a deficit or you're approaching one, you're in the opposite situation. That's where we are. And so our savings account is pretty nearly zero. And when that eventuality approaches, and by the way, it's not unusual to be at zero. It's not unusual to be negative. We just haven't been in that territory or very far into that territory since 2014. So we're there. And that's what markets are looking at. And they're saying, geez, if we have an unexpected expense, how are we going to pay for it? If we have another bombing at, in Saudi Arabia, or, if Libya goes offline, where's the oil going to come from? And before I leave this, your point about OPEC has plenty of spare capacity. Sure, they do, for a couple of months. But, markets are like CPAs. Markets say, well, yeah, okay, it's great that OPEC has all this, but we're kind of used to all this income that you've been reporting. And a big piece of that is US. And whether that oil is as usable as Saudi oil, another layer altogether. But we're used to that income. And so if Art Berman is telling you that oil production is down 2 million in the US, which everyone knows, and it's almost certainly going to drop another million and a half or more, then your CPA is saying you got a problem. And that's what markets are saying.
It's kind of funny because I have been thinking about the coma thing a lot. My thesis going into 2020 was that all the tier 1 inventory was drilled. We were drilling too tight. There was a level of capital discipline. It still wasn't as high as I thought. But then we saw declines in US production from the peak EIA 914 report was November 2019 at 12.85. And through March, before coronavirus hit, before anyone reacted, we were down to like 12.6. So we had declined 250,000 barrels. And the thesis was working. And my overall overarching thesis was the world produces 100 million barrels a day. OPEC doesn't have a ton of spare capacity. We're going to grow demand 1 million barrels a day. The US is going to shrink, not grow, and that's going to make oil 60, which means that on a relative basis, there's some undervalued companies. And we are sitting there again today. Obviously, we got kicked in the face by OPEC and COVID last March, but I'm curious where you think this goes. And I would tie Saudi to this because January 3rd or 4th, they came out and effectively unilaterally lowered 1 million barrels a day of their own production. And it stands to reason, as I understand it, they have 500 million barrels of their own long-term storage in the world and 50 to 60 of short-term. And so as we're pulling inventory out of storage, it seems that they're selling their own inventory to make up for the revenue. They've messaged to the market that they're down 1 million, which has then moved price up. So they've made up for it and they're making more. So how does Saudi play into all of this? And what did you take from the 1 million barrel a day cut and what it means for OPEC longer term?
Yeah, they were funny about that. I mean, they were, oh boy, do we have a surprise for you? And haven't we been good little boys and how well we've guarded this secret? So yeah, Saudi Arabia, they need money, they need cash. And Aramco certainly understands inventory and comparative inventory, and they saw an opportunity here to get a buzz on their revenue, and they've seized it. They're a little exhausted, I would say, with the negotiation piece of this, and they said, screw it, we're going to do what's good for us. And by knocking 1 million off, at least theoretically, we're going to boost the price a couple of bucks, and that'll be worth it to us. And that's exactly what's gone on. But I think the more important message is they're saying we're not worried about shale anymore.
Yeah.
We understand on our own. Maybe we read some of Art's posts, probably not, but there's just nothing. I mean, price could be $100 a barrel tomorrow, and there's just nothing that can be done in anything less than 6 to 12 months to increase production by anyone, but certainly who doesn't have spare capacity. And the stupidity of the meme that the United States was now the swing producer of the world. This was kind of a talking point by a lot of ignorant analysts back a few years ago. Well, you can't be a swing producer if you don't have spare capacity.
Yeah.
And we don't, and so we never were. So Saudi is saying, okay, even if the price goes up a lot more than we think it will, and even if all those guys in the shale companies get on the phone and get as many rigs as possible, it's not going to have any effect at all on supply, probably for a year. So look at all the money that we can make between now and whenever that happens, and it's going to happen anyway because price is going up on its own. I think the other point that's important here, David, is you correctly noted that if you just look at crude oil and not liquids, the decline from whenever it was, October, November 2018, really, until the beginning of COVID. I mean, that decline was already fairly substantial. And that was because, at least in the United States, that investors had begun their flight from what used to be their dream. WTI got to 75 or so dollars, 76, I think, in maybe July of 2018. And at that point, investors realized, well, the casino's closed. Share prices are as high as they're going to get because oil price is not going to get any higher. So the free money's gone. Let's get out of oil. And the excuses that were used, and it's just unbelievable to me how many naive people, gullible people believe the talk. Oh, well, now we're gonna show you fiscal discipline and we're gonna live off cash flow. That's a bunch of crap. It's just, I mean, it never was. And by the way, the investors didn't get out because they were worried about margins. That was just their talk. They didn't care about margins for 5 years or 10 years before that. They weren't making money on margins. Nobody was investing in Diamondback to retire on. They were investing in it because its share price had a good multiple on WTI. If WTI goes up, and it was consistently going up, you're going to make a killing. I mean, I calculated once that if you just bought a basket of tight oil companies and Chevron and Exxon and Conoco back in early 2016 and held it until the end of 2018, you made 250%. I mean,
yeah,
a better place for free money than that? Okay, it ended. It ended in 2018, and people started getting out. And they made a lot of excuses, as we always do. But the real excuse was we can't make any money here on the share price. It was always a stock play, in my opinion. Always.
Well, and I do. I mean, I echo those sentiments, and I've said the same thing about ESG. It's about if you can make money, and look no further than the tech shares and the number of companies that have zero profitability and zero potential to have profitability, and yet these stocks are in tech companies are up 4, 5, 6, 700%. Tesla's my favorite go-to right now as a nearly $800 billion company that makes $370 million a quarter, all of which is from carbon offset sales to other car manufacturers. So before we talk about oil and the impending decline, so do you think that we see 60, 65, Goldman Sachs came out and said they think there's 65 by the summer. Do you think we see that? And then I would tie this in. A lot of analysts have looked to the market and said, we see backwardation. So right now, prompt month is 52. And when you move out a year, it's sort of 45. And they're saying this shows that the market is today short, even though because of inventory, because of excess capacity, it isn't. It seems to me that the back end of the curve is all coming down because of hedging. And the front end of the curve is because there just isn't enough people in the, like companies have already hedged their barrels for February or March, so the volume can't move the needle. So where do you think we go? What is the strip reflecting? And do you agree with my thesis that backwardation is more a result of selling hedges than of really tight supply, like imbalance today?
Certainly out there a year or, whatever the contract term is of the hedging, yeah, that is going to push some portion of the mid, the mid forward curve down. But I think the near, the near 3 to 6 months, I think that's very real. I think of futures as a reflection of demand for storage. And so when oil price is low, demand for storage is high, and you're in contango. So you're always going to get more money later than you're going to get today. And when that situation reverses, when prices are increasing in the present and we don't know about the future so much, then we see backwardation because you're smarter to sell the oil as quickly as you can rather than pay the fees for storage and enter into the uncertainty that, well, we don't know. Maybe COVID shuts everything down, and I would have been better off to sell my oil sooner. So, I think there's a certain misapprehension about what a forward curve really means, and I just think about it as demand for storage. And if you think about it that way, it's just a lot simpler. You don't have to worry about, well, is the market really short or is it really long? It's just, does it, is it worth the carrying cost of storing oil? That's really all it's about.
So do you think that we hit $65 prompt month this year?
I think it's almost inevitable. However, the idea that we're going to go into a $65 market that is sustainable, I think, is improbable at best. So one of the beauties of being a student of comparative inventory is that I get used to these price discovery excursions. And there's a lot of people that look at and by the way, full disclosure, I didn't invent the comparative inventory method. A good friend of mine named Mike Bodell was the inventor, if there is such a thing, and he did it back in the early 2000s when he was working first for Unocal and then for Sarah. But anyway, I use it, and I guess I'm probably the most public practitioner of it. And so you look at some of the comparative inventory, the yield curve, what Mike calls it, and the yield curve is just the fit between the spot price and the comparative inventory, which is just the difference between the 5-year average and the current storage level this week or this month or whatever it is. And people say, well, that's not a very good fit. And well, okay, it's like human behavior. You've got 1,000 people, and you're judging how they react. Say they're investors. Who buys Tesla, who buys Apple, who buys a mutual fund, and it's all over the place. I mean, there's a wide variance, but there is a trend, and that trend is meaningful. And to me, the comparative inventory, it's not ever meant to be a mathematical regression. We are dealing with human behavior, human psychology, complex systems. And so the excursions from the yield curve are much more meaningful and informative than the trend. I'm a geologist, and the geologic record is completely indifferent to what's happening every day. It doesn't preserve it. It's the huge stuff, the catastrophic stuff, the 1,000-year flood, the Chicxulub meteor impact. That's the stuff that gets preserved. Those are the price discovery excursions. And so I firmly believe that the market believes that the marginal price of WTI today is $40 or $45. And the market is not going to change that view until there's some long-standing reason to do it. But it's going to push up the price. It'll take a detour from that yield curve, and that can be at least 30%. I mean, that's what previous excursions tell us. And so it's going to push and push and push until there's enough drilling to give the market comfort that, okay, now we've got supply under control, and then the price discovery is going to go in the other direction. And it wouldn't surprise me if we go, once that's achieved, if we get back to 35, because as long as there's someone on the other side of the bet who's willing to take it, then that's the way it works. I mean, these, traders, they are the discoverers. For whatever else you may think of them, it is their daily activity that finds, okay, what are the lower limits? At what point do people say, no, I'm not taking that trade anymore? And then it goes back the other way. So $65, sure. 70, maybe, who knows? But it doesn't really depend on, it's not a random thing. It depends on how quickly rig counts rebuild and how quickly supply is replenished. That's what it's about.
So let's talk DUCs, because we're going to pivot to the U.S. because I think, this is related to, we're going to see that the U.S. has been the only country really going back to 2008 that has materially grown. And we can debate the value of it, but we were effectively 5 million barrels a day in 2006, 2007. We hit at 13 million barrels a day, and now we're 11. So the U.S. has been the world's growth engine. And, we're going to talk about company economics, but one of the things the EIA publishes every week or every month is the DUC report. And I'm curious your view, because we've seen from the low in the summer, we saw 45 frac spreads. And based on Primary Vision's rig frac spread count last week, I think we're up to about 160, which is almost a quadrupling from the low. And the Permian was really the only one over the last couple of years that has continued to grow the DUC inventory. The rest of the basins, at least according to the EIA, are flat to down. And that makes a lot of sense. But it would seem that there's 3,000, 3,200, 3,400, some large number of horizontal DUC wells in the Permian that operators could go out and produce and bring online in the next 3-4 months. You don't see it that way. Let's talk about DUCs.
Sure. So drilled uncompleted wells. I'm in the business, drilling wells, producing wells, figuring out where to drill new wells, what to do with old wells, all of that stuff. Whether to take a working interest in somebody else's well or who to let in on one of ours. And so when a producer, when an operator drills a well, that's a big capital expenditure. Millions, let's just say for round numbers, in the Permian, it's probably $5 million to drill the well without completing it. All right. So the decision not to produce it is a horrible net present value consequence. And someone could say, well, yeah, but what if you spent another $5 million to frack it and complete it, and then it wasn't very good? That's sure, absolutely. So no producer in his right mind drills a DUC because it's a good idea to have spare capacity. I mean, let's just, that is the stupidest idea that I've ever heard a lot of analysts and journalists talk about. And that's because they've never worked in the business and they don't understand. And by the way, I have great respect for EIA and could not do what I do without them. But none of those guys have ever worked in the oil business either. And as far as I know, there are no geologists, there's no geophysicists. I doubt seriously there are any drilling or completion engineers at EIA. So they really, all they know is what they're told or what they come to believe. And again, I'm not disparaging them. They're smart people, but they've never done this. So when an operator drills, let's just say I've drilled 10 wells and I decide I'm going to complete 3 of them and I'm going to leave the other 7 as DUCs. Why would I do that? Well, because I believe that the 3 that I'm spending the extra 5 million a piece on have a better chance of being high performing wells than the 7 I choose not to. And by doing that, I'm taking 5 times 7, $35 million in net present value that's going to keep declining and declining and declining. And it's going to, I'm probably never going to be able, no matter how good those wells are, to end up any better than a net present value of 0. So it's a consequential decision. And I make it because geology is random. And obviously I don't drill a well because I think it's going to be a bad well. I drill every well. I mean, some of them I drill because I have to for some reason, but for the most part, I drill the well because I believe it's going to be a good well. But I have a lot of information from drilling it and logging it that often confirms that or refutes that. And if the data doesn't look good, then why should I spend another 5 million when I've got a different well that looks really good that I could spend it on? So the idea that all those ducks are equal is absurd. Geology is far too random.
That's a lot of ducks. I mean, so I agree on 100% on your net present value discussion. I've always been shocked that companies are picking up rigs. I've never thought of them as like really, really low quality. I mean, clearly some are in Culberson and it's gassy and there's water and there's H2S and you don't have infrastructure. But I always sort of gave the duck thing in the Permian in particular was that, you were ramping up rigs and drilling so fast, and there was just a limited amount of completion crews and sand and trucks and water. And so because the industry wanted to show drilling rigs, because everyone focuses on them, they were never able to keep up. So they built this huge inventory. I'd never really thought that of the, you're not questioning that there's 3 or 3,500 ducks. What you're saying is the quality of those is so low that the companies are completing their true ducks, their good quality ducks right now, but there's a lot of that stuff that doesn't get completed. And so without the drilling rig ramp up, we really can't get much higher than where we are today. Is that sort of the thesis, is that we're kind of tapped out on the number of completion units we're going to be running in the US in 2021?
There's a couple of points. So first of all, any well that was drilled and uncompleted before 2016 is probably never going to be completed.
Agree totally.
It was drilled under completely different economic assumptions. And so, subtract some number, a few thousand from whatever number you're working with to begin with. Okay, so there's a lot of wells that are counted as ducks just as part of the operational procedure of drilling wells on a pad. So we go out and we got a rig and we're going to drill, let's just say 10 wells on a pad. And each one of those wells, if everything goes perfectly, let's say takes a month. Okay, so we've now got 300 days. And that's when we're going to take off the drilling rig, move it somewhere else, and bring in a completion rig to actually do run the pipe and the cementing and the perforation and the fracking and all of that. And each one of those wells is going to take at least a week after we get the rigs changed out to do the frack and all of that. So we got 300 days, we got 10 wells that are each going to take a week, and plus we got a demob and mob and all that. So we're talking pretty close to a year between the time we started drilling the first well and the earliest time that we start producing the first well. So in the meantime, all of those 10 wells are ducks. Well, as they're drilled, they're ducks, right?
Yeah.
And so times the number of companies and the number of rigs. So you've got, I don't know what the number is, but it's hundreds, many hundreds of wells that are counted as ducks that are just waiting to go on production. There's absolutely no doubt that they're going to be completed. So that's a confusing part of this as well. To make it simple, in my most recent public post, that anybody can find on artberman.com. I just simply look at, forget about if it's a duck or a non-duck or, a crow. I don't care what it is. How many wells are we completing each month? And the number of completed wells is declining. And so call it whatever you will, and you can have whatever frac spread you like out there. We are drilling fewer wells, completing fewer wells every month than we were last month since March. So call them whatever you will. That has to turn around before we have any expectation of production increasing. So I've given you a lot of detail that some of your listeners will probably glaze over and say, oh my God, what's he talking about? Just remember, we are completing fewer incremental wells each month than we did the previous month. And then what's your expectation then for how long it's going to take for production to stop declining and turn around? Well, it can't be very soon, can it? You've got to get back to zero first.
Well, I'm with you. I don't think the U.S. grows this year, and so I definitely think that operators took their best inventory. But I remember in October, and I know you remember in October, when oil actually was 35. So I should have said oil will be 35 October 31st, because timing, as it turns out, is everything. Because oil was very close to 35, and yet operators all the way through November ramped up their completion rigs. And I think it was as large part to mask the underlying declines. So they had their 10,000 foot lateral wells that they've drilled. They were their most economic inventory. There's 10 on a pad. They've already built the facilities. That was the best bang for their buck. And so they ramped up, and then now prices have been pretty supportive. Let's talk about the companies and the business model, because one of the things you said earlier was, so we have $65 oil is almost an inevitability this year because of the lack of supply and the DUC discussion, and we can't bring them on for a year. And then the market gets rebalanced, and you wouldn't be surprised to see 35. Now, the average is 50, which is where we are right now. And at 50, E&P companies are pretty touch and go on economics. At 65, shale wells are good. They're pretty economic. And at 35, they're clearly not. So what does this mean for the listeners who are working for their small cap or medium cap or large cap, and they're trying to navigate drilling programs and economics and share price? And how do you see the dislocation of this wild swing in oil versus the companies? And would you just be saying, we got to hedge this, as much as you can at 50 and survive until we actually see OPEC supply coming offline, or rather like backfilling with demand? We see inventories come down. We see the US at 9 million barrels a day again, at which point then prices really will be majorly supportive, which is sort of my 2022, 2023 outlook. Well, how do you see that?
Well, I think we'll be at 9 million in 2021. I don't think there's any way that we won't be. Again, back to the EIA forecast of 11 million or 11.1 million average for 2021. It's, well, I can't even tell you what it is. It's just impossible. It's just totally impossible. And I'd love to have a respectful conversation with the people that run those models, because as I said, they're smart people, but it's just impossible. And it reflects their, I think well, it's real simple, David. They say it in, it's embedded deeply in something, and I've got the link on my website. But they believe that the turnaround between starting to drill a well and first oil is 2 months. And if you believe that, then I guess anything's possible. And that is possible in a handful of situations, one-off kind of situations where I'm just drilling one well. I'm not drilling wells on a pad. It's a vertical well. I'm not fracking it. The infrastructure is already there. I don't have to build a pipe to the nearest pipeline. That is
so like all 9 wells that are like that in the United States right now.
something like that.
Yeah.
So that's just goofy. I don't know what else to say about it. I think it's a very misguided assumption, and again, I'm not. I don't think that anyone's doing it to try to make the U.S. look good. I don't think it's agenda driven. I just think it's inexperience driven. And they say it. If you believe that a well can be drilled and completed and producing in 2 months, well, yeah, I guess your model makes sense. But the business model for tight oil, people have a funny idea that tight oil is somehow unique and completely different from everything that's ever been done in the oil business since 1859, and it's just not. And it's true that the reservoirs are much worse, and we have to spend a lot more money drilling and completing them to get the oil out of them. But the fundamental risk involved with the economic risk with drilling a well and making it commercial are not changed. And the idea that it was only shale that had negative cash flow or didn't have positive cash flow, it's just preposterous. I mean, if you look at, and I have graphs to show this. I mean, before shale ever happened, there was like maybe 1 or 2 years in the last 25 where E&P overall had anything better than zero NPV. It's just the way the oil business is. There's a lot of risk.
Yeah.
Spend a lot of money, and a lot of the money we spend doesn't return us anything. So that's the nature of the business. That's just the nature of the business. The fact that the companies are, as you said, they were ramping up their drilling towards the end of the year. Well, part of that is, of course, to make the year-end numbers look a little bit better, such as they can. But what that tells you is they do have money. There is capital available. If you read the headlines in Bloomberg or Reuters or whatever, you'd have this idea that these companies have absolutely no money, and that's ridiculous. If investors are starting to figure out that, oh, wow, oil might go to $60 or $65, maybe it's time to think about, buying Concho or Diamondback, you can guarantee that private equity and all the other people that are in there figured that out a whole long time ago. And so, and the capital available to these companies, a lot of it is much more opaque than you might imagine. And I'm not just talking about mezzanine financing. This is what some people call dark inventory. And dark inventory is that people, usually countries with a lot of money, will basically prepay an operator and say, look, we'll give you, make a futures transaction right now, over the counter, unrecorded, for $45. Okay, this is, and you haven't even drilled the well yet. And once you have, you're going to store it for me on the lease until I say, put it into the market. Okay, so that's someone who's willing to take the risk of owning the oil, not just a futures contract. And this number we see every week, unaccounted for oil, which is almost always a very large number. It's often the largest single factor in the crude oil stock change. It's averaged around 4 or 5 million barrels to the positive every week. Last week it was a little bit negative, and nobody pays any attention to that number. What is that number?
I've always wondered, and I know there's some guy, HFI, I think, research, they do some delta unaccounted for oil. I don't know what the unaccounted for oil is, and maybe it's because I'm thinking from a production reporting standpoint with a 2-month lag, which is why I trust the EIA 914 number. I don't really look at the weeklies, and I mean, I look at them directionally. But as you said, there's some huge gaps. So what is this missing oil? Like, guys are just leaving it in 1,600 barrels of tanks on location, and that's it?
It's not missing. That's the whole point. It's unaccounted for. What unaccounted for means is it's the difference between production and disposition. So when an operator starts producing a well, it has to report that to the state because the state needs its cut. The state needs its tax, and royalty owners need their royalty, and et cetera, et cetera. Okay, so if there's a difference between the volume that's produced and the volume that flows into the market that's sold, then that's unaccounted for. It doesn't mean it's missing. It just means somehow this oil was produced and it wasn't sold. So where is it? Well, it's sitting in a big tank on a lot of leases. And there was a time in the past when lease storage was accounted for by the EIA. And they stopped doing that in 2016 for obscure reasons that conspiracy theorists can probably make a lot of, but they stopped doing it. And that 2016, the Permian was not a big deal. If you drive around the Permian Basin today, I mean, look at the tank batteries that you see on both sides of the road. I mean, there's a huge volume of storage out there, immense.
True.
Okay.
True.
That's unaccounted for oil. And so who owns that oil? I don't know, because it's over the counter. I bet you Saudi Arabia owns a bunch of that oil. I bet UAE owns a bunch of that oil. Okay, so that's a way for them to hedge their investment. They buy low. Producers need money to drill. I'll give you 40, okay, and I'll take it. I drill the well. I hold it on the lease basically for free until you tell me to sell it, and I sell it for 50, and you made a big profit. I got what I wanted. I got money to drill. You got what you wanted. How big is that number? I don't know. But as I said, if 3 to 5 million barrels a week is unaccounted for, do the arithmetic.
Yeah, I mean that's a 700,000 barrels a day at the high end, and that's a lot of wells with 1,600 barrels or so of oil storage that are low producers. They produce 50 barrels a day. That was always my complaint whenever we built facilities, was you build these things for flush production, but then within a couple of years, they're not producing 1,000 barrels a day, they're producing 50, and you have 30 days of storage on location that you really don't need. But in this dark world you're projecting, then there would certainly be benefits if you're doing that. Let's pivot to natural gas for a second. So we saw, I want to go back 3 months, and we saw sort of 330, 340 gas, the running of the bulls. Oil was 35 at the time, and it was the running of the bears in oil. We've had this polar vortex, but we're still sitting in the 260 range. We see Japan, who's undersupplied for natural gas, all-time highs for natural gas. What is going on with gas and inventory, and why are we seeing prices kind of stubborn in the same range as they've been for the last 3 or 4 years?
So I'm working on a post right now called Natural Gas Amateur Hour. And I don't mean that in a disrespectful way, but to be perfectly honest, I mean, this is what happens when amateurs get involved with predictions and plays. And so natural gas is always sort of the stepchild. It's and nobody's as interested in natural gas, or most people aren't, as they are in oil, and until somebody says, hey, look at this, you could make a lot of money in natural gas. And the conventional wisdom about natural gas is that it's all about weather. If we have a cold winter, then we consume a lot and gas price goes up. And if we have a warm winter, then it sucks and gas price goes down. And, as with most conventional wisdom, there is some truth, or it wouldn't be wisdom, even if it's bad wisdom. But the problem is, again, comparative inventory. Just, where is storage relative to where it's been a year ago, 2 years ago, 3 years ago, 4 years ago. And what we see is, look at the big price excursions on natural gas, and they always happen in the winter when there's a cold snap. So it is weather, but they only happen when comparative inventory is negative. When you go into the heating season with a deficit of comparative inventory, And then there's a price spike and the market says, oh crap. And all of a sudden, spot prices are $75 in Boston, and futures and wellhead prices go to $6. Okay, you go into what turns out to be a cold winter with a surplus, comparative inventory surplus, and the market says, I got $10,000 in my savings account. I might take 500 out because I'm a little concerned, but I'm really not worried. And so we went into this heating season with as great a surplus. And if you don't want to do the comparative inventory, just make a plot every month, as I do. I publish it, of what the storage level is and how that compares to where it was. Just draw a curve of 2019, 2018, 2017. Are we higher or are we lower? Okay, so we were higher than 2016, which was the highest year ever. And oil and gas price was the lowest, by the way, during the winter. We've been higher than 2016 for the whole winter. And at best, we were at the same level. And so, it's like Casablanca. I'm shocked. I'm shocked that oil prices haven't gone higher than 275. Well, of course they haven't. Of course they haven't, because we got $1 million in our savings account. That's the way the market works. The market is cheap. The market, whoever the market is a skinflint. It never wants to pay a penny more than it has to. It's always short. And so if the market doesn't think it has to pay anymore, it's not going to. So what happened was a bunch of amateurs got in there and they said, oh, well, with all the tight oil wells producing less, there will be less associated gas. Check that off. Absolutely. And that means that there's going to be tight supply. And that means that prices are going to go to the ceiling. And there were lots of guys out there. I think HFI was one of them. $5. We're going to be $5.
I remember seeing that. And for a very brief window when gas was at 350, everyone was pretty excited about it. And I agree. You look at inventories and also capacity in the Marcellus to bring on as much gas as you want.
And people were telling me I didn't know what I was talking about. I'm an idiot, and I'm often wrong, but I've been doing this a long time. And for those who follow, who subscribe to my weekly comparative inventory, I do a gas and an oil one separately. You'll see that, in the gas inventory report every week since long before October, I was testing and probing this thesis that we're going to have higher prices. And for sure, prices are higher compared to the dumps that we were in. And I think the markets have increased the marginal MCF by about 75 cents, and that's not going away. But it all gets, so the way I think about it is look at comparative inventory and weather is an accelerant. And if comparative inventory is low, then the accelerant effect will be great. If comparative inventory is high, the accelerant effect will be more modest. And that's just the way it is. Now, having said that, the amateurs just got their timing wrong. That we will be in a comparative inventory deficit by the beginning of next winter. That's the time to play gas. Well, the time to play it is before then, obviously, but that's when you're going to see it. And it's the same phenomenon. You can't produce an MCF of gas any faster than you can a barrel of oil because you got the same operational process with the pad drilling. So there are so many people that think technology is going to solve all our problems. And I'm a great believer in technology. At the same time, there's always a plus and a minus. And so, in my opinion, the biggest breakthrough in oil and gas since 3D seismic was pad drilling. And with 3D seismic and with pad drilling, there was a negative, and it was always cost and time. So it just costs a whole lot more money to shoot a 3D survey, and it takes a whole lot more time to process it. And you find smaller and smaller new fields. And so pad drilling was a big breakthrough for cost efficiency, but it has a negative, and the negative is that it takes a whole lot longer to get first oil out of the ground. The biggest breakthrough in the oil business before that was rotary drilling. I mean, these are big breakthrough events, but every one of them involves substantial cost and time. You just don't get any free lunch. That's the way it works.
And so it's interesting because I started this episode by talking about the coma. And, in March, I think a lot of people were saying, look, there's world demand is going to be impacted. There's a lot of supply. It'll rebalance. But ultimately, a $35 to $45 world right now isn't necessarily unrealistic, but we're going to have huge volatility. And that the net long impact on natural gas is less oil, less associated, less investment, less cash flow. And so gas kind of goes. And so if you snap from 2020 to the beginning of 2022, that seems to be in play. It's this volatility based on the inventory and the markets giving us signals that are very confusing. So if you were to say, what are you most afraid of risk-wise? And then we'll close it, because there seems like there's a lot of risks in the background, whether it's UAE and Russia doing their own thing, whether it's Saudi snapping their fingers and making a different decision, whether it's cold winter LNG exports. What is the biggest risk that you think about right now in terms of what faces our market, either positive or negative?
Right. And before I go there, let me just add, for those who are going to, throw tomatoes or darts or whatever, the export part of natural gas is a big consideration. And that's something that's not new. We became a net exporter of gas in 2016. But I mean, we're now, our net export for both pipeline and LNG is 11 BCF a day. And so that's a big component of demand that wasn't there before. And so a lot of the arguments that called for $5 gas were in part based on, we're going to be ramping up LNG exports. And,
and ships there, because there has been such a large ramp up, isn't built out. And so prices to move LNG have moved up commensurately. And
Sure.
It's similar to the oil tanker situation at the beginning of this year. When oil prices were dropping, everyone was looking for tankers to store oil. So prices went crazy. LNG, we've seen the same thing with Japan. So certainly a lot of dynamics to consider.
It's a hugely complex system. As far as risks, honestly, I don't see any risks that are that are beyond the ordinary risks. I know we as humans like to invent narratives. I live in a reality of unresolvable uncertainty, and so there's as soon as there's some falling out between Russia and Saudi Arabia, and they do something incredibly stupid, like they did in March. There's a countervailing effect somewhere else, and I don't know where that is. My sense is that our optimism about coronavirus is probably misplaced in time. We're dealing with humans, and let's say that the vaccines are 100% effective. There's a bunch of there are a whole lot of people that are just living in their own infantile fantasy that they're not going to get a vaccination because it's probably Hillary Clinton in her pedophile pizza pizza shop in Philadelphia that's manufacturing them, or people they just believe the goofiest things, and so a lot of people aren't going to get vaccinated. Maybe eventually they will, but I just we've already seen that the rollout has been hugely disappointing. Again, that's I'm I'm not blaming anyone. That's just the way humans are. We don't do things as well as we expect. And our expectations, whether it's, a decay curve or a growth curve, we always imagine all the worst things are going to happen at the same time, which they never do. And the decay curve ends up being a lot flatter and a lot longer than we thought. Or we think all the good things are going to happen at the same time and they don't. And our growth expectations are disappointed. So I think that if you're betting, if you're an investor and your bet is that we're going back to normal on, say, oil demand or energy use, I'd be cautious on that bet. We're going there slowly. If your bet is ESG, that oil is over and we're all going to be driving electric cars by 2025, and I think that's a hugely delusional view, and I don't say that as an oil and gas partisan. I say that as an objective scientist, and for people that think that we can get off of fossil sources of energy anytime in the near term, they don't understand the physics of it at all, and I'm not looking down on them. I'm just saying, that's wrong. So if you're playing the stocks, if you think you can make a lot of money in some ESG investment on the share price, go for it. You probably will. But if you're betting that that there aren't going to be any oil companies in 10 years, you're going to be hugely wrong. If you're betting that the world is going to be running on wind turbines and solar panels in 15 or 20 years, you're going to be wrong. And if it is, it's going to be the poorest world you can imagine, and there just isn't going to be any economic growth. And again, that's not I'm an environmentalist. I believe in climate change. I think we're going to have to do something. Like with technology, there's pluses and minuses, and whether we choose to adapt or whether the world forces us to, it's going to be a poorer world going forward. So the biggest risk, to answer your question, the biggest risk that I see isn't anything specific about the energy market. The biggest risk is that we have a global economic collapse, which we're always on the verge of, and nobody wants to think about it, and nobody wants to talk about it. But the system that we have is hugely fragile, and we have done nothing but increase its fragility. Certainly, well, we've been doing it since 1970 in this country, but since 2008, we've solved the problem of a financial crisis with more finance and more derivatives and more more money supply, and we are solving the problems of COVID with the same. And so all of that increases the risk of a financial collapse or a flat out economic collapse. I think our credit system is the biggest risk. We've got millions and millions of households that can't pay their rent. Okay, so one creditor doesn't get his money, that creditor can't pay his creditor, can't pay his creditor, and it doesn't take. And so right now we're feeling a little bit comforted by the fact that the government is going to make it all okay, but it just doesn't take a lot of perturbation in that system before confidence is lost, and that's when we see collapses. And if that happens, I don't think it's going to be the end of the world. I'm not one of those people at all. I don't think we're going to see open warfare, although, again, back to infantile fantasies, we've got plenty of those people out there. Always have, by the way. It's not Trump's fault. He hasn't helped, but it's not his fault. These people have always been out there, and there's a lot of them. There's a lot more than any of us really want to admit. But I think the risk to the functioning of the credit system in the world is the biggest risk. There's nothing we can do about that.
I tend to agree on that. And so with that, Art, we will leave it there. Our 100th episode is in the books. I appreciate you being the guest. And people can follow you on Twitter, obviously, Art Berman, easy to find on Twitter, and go to artberman.com. Check out the comparative inventory reports. I agree. It's all about inventories, and Art does a really, really good job of laying it all out there for you. So even if you disagree, you have the data, and you can make your bet the way you wish. So Art, thank you so much. Happy New Year. Great to see you again. And I look forward to staying in touch and chatting with you next time.
And it's been an honor to be your 100th show guest. So look forward to talking to you again soon.
Awesome. Thanks. Until next time, be safe, be good, have a great day. And with 100 episodes in the books, bye for now.